When the market is moving sideways inside a tight range, many traders struggle to understand what price is actually doing. That confusion often leads to emotional decisions, forced trades, and unnecessary losses. But by the end of this video, you are going to understand one of the most powerful concepts behind ranging markets and how to avoid getting trapped during this phase of price action. Because what looks like confusion on the surface is actually balance underneath. Now take a closer look at this chart. Price is not trending. Instead, it is moving sideways, pushing up aggressively, rejecting, dropping back down, and repeating the same behavior again and again. But here's the truth. What looks like confusion is actually balance. A ranging market simply means equilibrium. Buyers and sellers are temporarily equal in strength. Price moves up, then gets pushed down. It rises again, then gets rejected. It is not trending. It is rotating. Think of it like a crowded marketplace where both buyers and sellers are active at the same time. There is no clear winner, only constant negotiation. And in that kind of environment, noise increases and clarity decreases. This is exactly why range conditions are dangerous for most traders. First, stop-loss placement becomes a trap. Traders often place stops at obvious swing highs and swing lows inside the range. But in a balanced market, those levels are liquidity points. Price naturally sweeps them to fill orders before reversing again. What feels safe is often the most exposed. Second, the risk-to-reward structure becomes inefficient. In a range, price is confined. Even when your direction is correct, the movement is limited. That means you are risking capital for very little upside potential. Over time, this slowly destroys consistency. Third, probability becomes unstable. Price inside a range is not trending. It is rotating randomly between boundaries. Entries become harder to time, and even good-looking setups can fail simply because the market is still balanced. This leads to repeated stop-outs and emotional trading. But professionals don't fear ranging markets, they understand them. They approach them through auction market theory, the movement of price from balance to imbalance. You'll learn more about this powerful concept as you go deeper. It's reserved for those who are serious enough to invest in their learning through my paid subscription. If you understand this, you stop chasing random moves and start reading the story the market is actually telling. And if you want more, follow for more breakdowns like this, where I turn confusing price action into clear, structured thinking.